If you have never heard of Jack Bogle, you are in for a treat. John C. Bogle, also known as Jack Bogle, changed the game in 1975 when he launched Vanguard. Now, Vanguard launched the index fund, which was one of the biggest innovations in the last 100 years. With the index fund, Jack took a huge risk, and actually he was ridiculed for many years for giving up on trying to beat the market. Well, did it pay off? Today, Vanguard is the largest provider of mutual funds in the world. So yes, it was an amazing victory. Before Jack Bogle, investors were losing half their retirement nest egg, which they'd spent decades and decades building to fees. So Vanguard and the index fund changed the game and let the average investor win the game. As you can see, I'm really excited to be sharing this video with you because I'll be showing you which index funds Jack Bogle used himself and also why. As always, if you find anything in this video useful, be sure to click that like button. That would be much appreciated because every like does help. Okay, sit back and relax. Here is the investment profile of Jack Bogle, founder of Vanguard and the index fund. Here is what we've got coming up. We're first going to look at Jack Bogle's portfolio. We'll then take a look at index funds today and see what the trend is. And then we'll finish with Jack Bogle's 10 investing rules for success. Owning the stock market over the long term is a winner's game, but attempting to beat the market is a loser's game. So here it is, guys, Jack Bogle's portfolio. And he would recommend for a starter, so this would be someone in their 20s, maybe their 30s, the portfolio would look like this. As you can see, it's very simple, deceptively simple. In fact, it's just one fund, the US Total Stock Market Index Fund. So this would include pretty much nearly all the companies in America. So there's approximately, say, 4,000, and this would be micro cap companies, small caps, medium and large companies. As you'll see in an interview later on, he says if he could only invest in one thing, this would be it, a US Total Stock Market Index Fund. One of the biggest complaints people say is that this is just US and not international. And so other people would say you should be taking international stocks as well. But Jack Bogle is quite famous for saying, by buying the US companies, you are international by default. Think about it. Apple manufactures its products in China and India and sells them all over the world. So these big US companies are international. So by buying this fund, you are by default in international companies. So how has this fund performed? Let's take a look. So this is the Vanguard Total Stock Market Index Fund, and we'll look at the last 10-year performance. So from 2010 to today in 2020, it would have returned 22% a year, and this return is outstanding. It's probably only fair to point out that the 10 years before that were not as good. The last 10 years is one of the biggest bull markets in history, but still, for a 10-year performance, this is excellent. And as you get older, Jack Bogle is famous for saying you should probably increase your bond holdings similar to your age. So once you get to about 40 or 50, your portfolio would look more like this. You'd still have 50% in US Total Stock Market Index Fund, but now you'd have 50% in a US Total Bond Market Index Fund as well. And this is going to hedge your risk. It will bring your returns down, but it's a much safer portfolio. And then when it comes to later in life, his retirement portfolio is likely to look something like this. So again, you're still US Total Stock Market Index, but this time it's only 20% and 80% would be in bonds. So again, a much safer portfolio to protect that nest egg that you've spent your entire lifetime building. And you've got to love the simplicity of this portfolio. Buying funds based purely on their past performance is one of the stupidest things an investor can do. So I've got a couple of charts to show you, and they're pretty incredible. So this is going back approximately about 20 years, and you can see this is index funds in dark blue and ETFs in light blue. Now, ETFs are pretty much the exact same thing as index funds. They're just traded on exchanges, hence the name ETF, exchange traded funds, but essentially they're pretty much the same thing. And you can see the first index fund created by Jack Bogle was in the 70s, so nothing really happened that much for about 30 years. In fact, he got ridiculed for just accepting market returns. But once we had 10 to 20 years worth of data, people realized that index funds actually beat the vast majority of people. So you can see from the year 2000, so the last 20 years, what is happening right now is there is a huge migration into index funds and ETFs. In fact, here is a Bloomberg article from about a year ago, and it says, "End of an era. Passive equity funds surpass active in epic shift." So it's official. Inexpensive index funds and ETFs have finally eclipsed old-fashioned stock pickers. Passive investing styles have been gaining ground on actively managed funds for decades, but in August, this was last year, the investment industry reached one of the biggest milestones in modern history, as assets in the US index-based equity mutual funds and ETFs topped those in active stock funds for the first time. So this has just happened 1 year ago. Index fund have proven the winners. Don't do something, just stand there. So this is a great quote because the famous saying is, don't just stand there, do something. When there's a crisis on, people freeze and it's like, don't just stand there, do something. But he has reversed it to don't do something, just stand there. And this is great because 99% of the times when stuff is happening in the market, whether it's booms or busts, the best thing an investor can do is nothing. Just keep investing for the long term. And let's finish with Jack's 10 investing rules for success. Here they are. Number 1, reversion to the mean. Number 2, time is your friend. Number 3, buy right and hold tight. Number 4, have realistic expectations. Number 5, forget the needle, buy the haystack. Number 6, minimize the croupier's take. Number 7, there's no escaping risk. Number 8, don't fight the last war. Number 9, the hedgehog beats the fox. And number 10, stay the course. Now, instead of me talking you through these, why not hand over to the legend Jack Bogle himself as he talks you through his 10 investing rules.
In your book, The Clash of Cultures, you have 10 investment rules for individuals. Let me just quickly take you through them and just tell us. Sure. Remember reversion to the mean. What do you mean by that?
Okay, that's that's number one of the rules, and that's the most important of all. Don't look back at past performance, because all mutual funds, one way or the other, if they do very well in one period, they will do badly in the next period. If they do badly in the first period, they'll do well in the second period. It's so clear in the industry data, but reversion to the mean means don't think the past is prologue. It rarely is, and sometimes it's anti-prologue.
Number 2, time is your friend. What do you mean by that?
Think of the value of compounding. Get yourself out a little compound interest table and see that at 7%, money doubles every 10 years, and then it doubles again, and then it doubles again, and then it doubles again, and doubles again, and doubles again. And by the time you're at retirement age, if you start investing when you're 50, it's multiplied, you'll have to tell me, but let me say 35 or 40 times over. Unbelievable, maybe even more than that.
3, buy right, hold tight.
Okay, buy right, hold tight means don't make mistakes at the start, pick a good fund, and hold it through thick and thin. And I would argue very strongly, if you're looking at an actively managed fund, and you should be very careful to buy the low-cost ones, even if it's actively managed, that don't get despondent when it does badly, because it comes and goes. So hold tight, buy right, hold tight. means don't let yourself be diverted by changes in the manager's performance unless it's grossly excessive, and by changes in the market. You know, we had all these years of 17% annual returns in the 80s and 90s, and people were surprised, I can't imagine why, that we had essentially zero return on common stocks in the first decade of the 21st
Reversion
century.
to the mean again.
Reversion to the mean, absolutely.
Have realistic expectations. In this new normal, what's a realistic expectation?
Well, I still think Bill Gross, who does the new normal kind of idea, is a little bit below me, but I think common stocks should earn a nominal return of around 7%, nominal meaning before inflation. And I don't make that up. I think the dividend yield is a very, very important thing in this, and that's 2% today. So corporate earnings should grow at about 5% in nominal terms. I think that's about right because corporate earnings grow at the same rate as the economy.
Forget the needle by the haystack, you buy the whole market. Why?
Yeah, well, it's because buying a good manager is like looking for a needle in a haystack. And everybody knows what that's about. Good old Don Quixote had it about right. And so it just makes common sense. Own the whole market and not just a few stocks. You don't need to take the risk of individual stocks. Take the market risk, which is quite high enough. You don't take both.
We talked about this before, but it's minimizing the croupier's take, and which means that just go for low cost.
Go for low cost funds,
Right.
and especially index funds.
There's no escaping risk.
Think about that for a minute. I don't like the risk in the stock market. So put your money in a savings account, certificate of deposit. There's no risk there. Wait a minute. The return there is probably going to be about 1.5%, and we're going to have 2.5% inflation. So the real return is essentially, and this has been true all over history, that the return on a savings account, the nominal, not the nominal return, the real return, the nominal return of say 1.5% at the moment, very, very low, turns into a real return of minus 1%. So is there any risk in putting money in a savings account? You better believe it. And everybody needs a little bit of an anchor to windward, but keep that low. And of course, in these days with the money market, I would strongly recommend short and intermediate term corporate bonds to replace at least part of that, because the yields there at least exist. Saying something these days.
Beware fighting the last war.
Everybody, I mean, a great example is people started to worry about inflation about 20 years ago. And so we had funds, inflation beaters fund and all that kind of thing. That was the last war. Inflation then pretty much stopped for a long time. And the inflation that we had from, let me say, post-World War II to, say, around 1980. And we always have some inflation, but it got to be 6, 7, 8% in some years. And so people want to protect themselves about that. So part of that caution is your job is to get the biggest gross return, because inflation is going to take whatever it takes out of that return. And if it's a big return, it will move it down a little, but if it's a little return, it will eliminate it. So you want to think of it, you never want to forget that.
The hedgehog beats the fox.
That's one of my favorites. I didn't make it up. There's a Greek poet back probably in the 3rd century BC named Archilochus, and they found a little fragment of Archilochus' writing, and it said, "The fox knows many things, but the hedgehog knows one great thing." And in our business, the foxes are all those managers, smarter, they got all those computers, all those brilliant Harvard Business School graduates, armies of them, and they know everything. And they know far more than I could dream of knowing. I know one great thing, and that is if you own the market, which they do collectively, naturally, if you own the market, you are guaranteed, in a low-cost index fund, you are guaranteed to earn your fair share of whatever the stock market is kind enough to give us, and let's be very clear on this, whatever return a bad market is mean-spirited enough to take away from us. So it's the hedgehog who wins.
And your final rule for investors is stay the course.
One of my favorites, I use a lot in the book, and that is most investors, many investors, probably the majority, lose because of their own behavior and not because of how stocks and bonds do. They are trailers, they buy something that's done well and think it's going to do well in the future, and it doesn't. A whole lot of bad behavioral patterns. If they find a hot manager, they jump on the bandwagon, and that doesn't work. They just can't do it. And the markets are really, just think about this for a minute, really counterintuitive, because when do you feel you're most optimistic and most happy and enthusiastic about buying stocks? At the market peak. When are you scared to death about stocks and really want to get out? At the market bottom. So you get at the top and out in the bottom. Do you think you're going to do well doing that? So figure out a sound program, I would argue, one with an appropriate part of bonds and bond funds, really, and stock funds, index funds, I would say, in both cases. And let that allocation favor bonds a little bit more as you get older, and finally quite heavily when you get to retirement, and almost all in stocks before you start down that road. And that's a good formula for work. It doesn't have to be a formula, but a good rule of thumb, heuristic, as the academics would say. And so that's what staying the course means. Set the right course, and then don't let all these superficial, emotional, momentary things get in your way. Another way of putting it is, don't do something, just stand there.
So, Jack, the one investment that we should all own in a long-term diversified portfolio, what would you recommend that we all own something of?
Total U.S. stock market index fund.
Okay, so there you are, guys. That was the investing wisdom of the legend that is Jack Bogle. I personally love the simplicity of this investing strategy. And if all you ever did was open an account with Vanguard and invest all your money in a US total market index fund or ETF, you would be 99% of the average investors over the long term. Now that is so important, I'm going to say it again. If all you ever did was open an account with Vanguard and invest all your money in a low-cost index fund in a tax-efficient way in the US total stock market index or ETF, you will be 99% of the individual investor over the long term. How amazing is that? Now, if you're interested, I've also done some other billionaire portfolios. I've done Warren Buffett's portfolio, Ray Dalio's portfolio, Jeff Bezos. Now, if you want to see those, I'll drop links below this video. If you did find anything in this video useful, be sure to click that like button. That would be much appreciated, and every like does help. If you haven't yet subscribed, be sure to click the subscribe button and join us. I do have some great videos coming up that you don't want to miss. And if you've got any questions, any comments, just post them below and I'll reply to every one I can. Okay, cheers guys. Thanks for watching. I'll see you in the next video, and it's bye for now.